every single candlestick that you see, like the candlestick we see right here, that tells you the direction in price. It tells you what the next candle is likely to do with very good accuracy. And the reason why that is because that candle is also fair value gaps. But fair value gaps right there are also then in turn singular candles. This is what we know as candle signs. And candle signs is predicting the next candle based on the previous candle's close, where you don't need to pay attention to all these different candles and get very overwhelmed. No, when you understand one singular candle, you understand every single candle on the lower time frame. So this is episode number 2 of Pips to Payout, where we are going to discuss candle signs, how that helps us in understanding what the bias or the direction of price actually is, when we know we are respecting or disrespecting certain PD rays, and also exactly knowing through 2 candle rejection how long it should take before we continue higher from a certain PD ray. In other words, it gives us a whole lot of clarity, an exact understanding. It's like we're in control. Now, the reason why candle signs works is because of fair value gaps. It's purely based on fair value gaps, and also, like we discussed in episode 1, order flow lags. So like we evidently see right here, when we continue lower, we create bearish fair value gaps. When we continue higher, we create bullish fair value gaps. So in other words, fair value gaps in general are quite accurate in telling us the direction of price. That's why we use order flow lags. But these are fair value gaps on one time frame. But for example, if you zoom out, they turn into singular candles on a different time frame. So for example, this recent candle that we see right there, the monthly time frame is just a singular candle. But if you go into the daily time frame, that turns into fair value gaps right there, continuing higher. But then I also need you to understand that candle signs is really powerful when you combine it with the PD rays. So quickly recapping, which PD rays are we talking about? What are the PD rays that we use? Right here, we're looking at a bullish order flow lag. What makes it a bullish order flow lag again is the fact that we have a swing low right there. That's the first PD ray that we have. In a bearish scenario, again, that's going to be a swing high. Then after that swing low, we also have a fair value gap. Now, because we have the fair value gap right here in this lag, in this bullish lag, it makes it an order flow lag. Very powerful in giving us that direction. Now, the last and the third PD ray that we have is a fair value area. It's essentially the retracement before we continue higher right there. Again, fair value area, not something we're going to dive into right now. We're going to, again, focus on the fair value gap and the swing highs and swing lows. But I need you to understand, candle signs and the concepts we're going to talk about works with all the PD rays, all the 3 PD rays that we use right here. Now, what we're going to work towards right here is clearly understanding in what is a bullish trend. And I don't mean just opening your chart right here and seeing, oh, well, this is going higher right there, so that must be a bullish trend. No, a little bit more in depth than that, actually objectively breaking it down. For example, the way we objectively break down what a bullish trend is premium arrays are being disrespected, discount arrays are being respected. That's a bullish trend. So you already understand what premium arrays are and you understand what discount arrays are. So I'll quickly repeat myself. Premium arrays are the bearish variants of PD rays. So that means bearish fair value gaps, bearish fair value areas, and swing highs. Discount arrays are the opposite: swing lows, bullish fair value gaps, and bullish fair value areas. But the thing that we are not very aware of is, what does it actually mean for premium arrays to be disrespected and for discount arrays to be respected? And I mean objectively. Now, on the other side, we also have, of course, a bearish trend, so where we are continuing lower. Now, we can call it a bearish trend when premium arrays are being respected and discount arrays are being disrespected. So the exact opposite of what a bullish trend is, of course. Now, at first, you might see these sentences and you might think this is a whole lot of abracadabra. I have no idea what this all means. This video is going to give you a whole lot of clarity. That's the goal, where you can see sentences like these and you can know exactly what it means, but then also in turn know exactly what you're waiting for or what you want to see. And that clarity, that's priceless in my opinion. That's very powerful. All right, so first of all, what we see right here and what we talked about in episode 1 as well, when you start marking out these PD rays, because the PD rays, that's the foundation of the bias, so the direction in price, because we're always moving towards PD rays. It's just our job to find out which PD ray is next. So right here, we have a swing high and we also have that unmitigated fair value gap right there, the bearish fair value gap. Then these order flow lags right there, they will tell us where we are going. So which PDRA is next? They are essentially the guide that we have, the compass. So a bullish order flow lag right there is moving towards that swing high. Well, that will give us a whole lot of confidence that we are moving towards the swing high. So that's going to be the target. Now, one thing that you will notice right here is not only do we then know that, we know the exact candles that will deliver us there as well. So we have this bullish order flow lag. We see right here, we have a fair value gap that we trade back into. Then we have this candle. And that is where candle science now comes in. Because candle science then tells us that the next candle can reject towards the target. So giving us a very accurate idea of where to look to get involved. And then of course, afterwards, we can also do the same new fair value gap towards the next target, which is that bearish fair value gap. Now, again, this also works in the same way right here. So we again have the same targets right there. We again have the fair value gap that's holding, but it also works with that liquidity lag. So what we just saw when we have a lag right here with a fair value gap in it, that's an order flow lag. But when we have a liquidity lag right here and we have that swing low that we can sweep to then continue higher, the same way. So we have that singular candle that tells us that it's being respected and that we can now look to continue higher right there. And that's why candle science will take us to the next step, because that will give us clarity and also accuracy. So when we move on right here, in candle science, there are two types of candles. First candle that we have is a respect candle. And a respect candle right here looks something like this. Again, combine it with a PDRA. So for example, right here, we have a certain PDRA, might be a fair value gap right there, that we sting back into. Then we see that from that fair value gap, we create a respect candle. Now, the characteristic of a respect candle is a long wick. So that's either going to be a bullish respect candle where we have a long wick at the bottom, like we see right here. A bearish respect candle is a long wick at the top. And the reason it's called a respect candle is because, well, it's respecting something. So it's respecting a fair value gap right there or any other PDRA. And that long wick, that tells that it's respecting it because that long wick on a different time frame, so the lower time frame, is going to look something like this, where we have first fair value gaps going lower to then fair value gaps going higher. In other words, that's a reversal that we're looking at. Now, this one right here is the most obvious one right here. It's very textbook. We reach above this swing high right there. When we reach above that swing high, we create this long wick, a very long wick. Now, that is a very long wick on one singular time frame. But again, if you go into the lower time frames, for example, the 50-minute, that turns into fair value gaps going higher. So order flow lags first being bullish to then order flow lags turning bearish right there, so continuing lower. So what happens actually, that's just a reversal. That's where price is telling us that it might want to continue lower and where it can continue lower. So again, on one time frame, that's going to look like a whole lot of candles, but we can understand that based on that singular candle, just based on that wick right there, that we might want to continue lower instead. Now we're going to dive deeper into this when we get to the two candle rejection, because that's where it really starts to apply these concepts right here. So then, of course, the second candle that we have right here, well, I say, of course, it's not that obvious, is a disrespect candle right here. A disrespect candle is essentially the opposite of a respect candle, because a disrespect candle doesn't really have any long wicks. It has quite tiny wicks, but pay attention because there's a very large body to it. So when the candlestick has a large body like that, that's what we know as a disrespect candle. Now, this one is a little bit more straightforward. That means right here, when we create a disrespect candle, that on the different time frames, on the lower time frame, that's simply going to be fair value gaps moving into one singular direction. So essentially, it's a continuation. Again, the key is right here, combining it with PDRAs. So right here, we see we have this swing high. We also have this swing low, for example, right there. Now, on the 4-hour time frame right here, we see that when we reach that swing high, we create this respect candle. When we create that respect candle, again, all price is doing, all we are essentially assuming that price is doing, is constantly following through on the most recent order flow lags that it has been creating, like we talked about, the most recent fair value gaps. So when we create a reversal right there on the lower time frame, then we expect these fair value gaps to follow through. So this right here is a reversal. So when we have a respect candle, in this case a bearish one, that means we expect the next candle to potentially continue lower right there. Now, when we then create the next candle right here, this next candle is then a disrespect candle. Now, of course, I'll give you that. It's quite a long wick right there at the bottom as well. But the key then is combining it with the PD raise. Because right here, we have a long wick, but that long wick is not coming from anything. There's no PD rate right here, at least not on this time frame. So it's an irrelevant long wick. It's not respecting anything. That's the key. So right here, we can still continue lower, assume that is a disrespect candle and a new disrespect candle right there until we then reach, for example, that swing low that we have right there. So again, then every single candle close predicts what the next candle is likely to do and then predicts what the next target is likely going to be. So we understand the two types of candles, respect candle, disrespect candle. It's time to apply them in two candle rejection. That's where it's really going to get powerful. So moving on right here to two candle rejection. I need you to understand it's sort of this innovation path, which is quite funny to me because that's how we develop certain things in the MMT, certain concepts. It's a constant innovation path. So we take, for example, something like fair value gaps. Those fair value gaps, they turn into order flow lags. Those same order flow lags and fair value gaps, they turn also into candle signs, so singular candles. Candle signs then allows us to understand as well two candle rejection. So that cycle goes on and on and on. The same way that we initially had a computer, the computer was quite big, then it put it into your pocket, into a phone, became a BlackBerry, then eventually an iPhone. It's a constant innovation cycle. So when you understand candle signs, you already understand two candle rejection. Because right here, for example, we have this fair value gap right there. Now two candle rejection then allows us to understand how long it actually takes or what we can expect when we reach a certain PD rate. In this case, it's that fair value gap. When we reach it, and the first candle is a respect candle. I sometimes also mention this as the first candle is a rejection. Then we can expect the next candle right there to continue higher and potentially become a disrespect candle right there. But it's two candle rejections. So essentially there's two options of what can happen. This is where the first candle is a rejection right there, but it's not always going to be the case. Because sometimes, for example, we have this fair value gap right there, and the first candle right there is not a rejection. Why that usually is the case is because during the candle duration, it did not have the time or did not have the strength, etc., to push price higher at that moment in time. So what then tends to happen is that then we're going to use liquidity in the form of a previous candle low right there to then sweep it to then continue higher. So in other words, either it's going to be the first candle or the second candle. Now, after we have the second candle right here being a rejection, we expect the same. And the third candle can continue higher right there, create that new disrespect candle. Now, start playing around with this because this is, well, quite frankly said, it's quite a lot of fun. The first thing you can do is when you mark out all the different PD rays around you. So, for example, we have the fair value gap, we have a swing high right there, we have a swing low sitting right there, and we also have this bearish fair value gap. Now, of course, there's more as well towards the left. But let's focus on these. And then start seeing how long it takes for price to reject away from a fair value gap. So when we trace back into it, to then continue higher. Or any other PD rate can also be, again, swing highs, swing lows, fair value gaps, and fair value areas. Now what you'll notice is that it usually takes one or two candles. That's why it's called two candle rejection. Now what's important to understand is you apply two candle rejection to the same time frame as the PD rate. So for example, this right here, bearish fair value gap, it's on the 1 hour time frame. So we look at two candle rejection on the 1 hour time frame. In some cases, you can also go one time frame below. But for now, let's just stick to the same time frame. So for example, we see right here that actually the first candle, well, I would also argue that this does look like a respect candle right there already, but it still sweeps the previous candle low right there to then continue higher. With this swing high right there, it was the first candle right there. And then you'll start noticing certain patterns, which is very interesting to me. We respect right there the swing high that allows us to trade back into the fair value gap, which we then respect to then continue higher. Creates a ping pong effect. Anyway, all things we're eventually going to dive into. And then, for example, from this fair value gap, we see the same thing. First candle, not a rejection, sweeps the previous candle high to then continue lower. Then the first candle is a rejection right there from the swing low to then continue higher and create those disrespect candles. I can't emphasize enough on this. Two candle rejection is so extremely powerful and it's so interesting to me. So if you find this interesting, the best thing you can do, open your chart, start marking out all the PD rays around you, just play around with it, see what it does, observe it. That's super interesting. And that's exactly where you're going to learn a lot before you go into live trading, not financial advice. Now, once we understand two candle rejection, we can now get to closer understanding of what a bullish and a bearish trend is, where we need a rejection high, rejection low as well, which we're going to dive into. First, I want to talk about what are we doing. And before we move on, I want to be completely transparent and completely honest. At the end of this video, I'm also going to try to offer you something, so to try to sell you something. I need you to understand that's not going to be for everyone. And there's also zero pressure, there's no urgency, your life doesn't depend on it, and there's also no magic Lamborghini after you buy it. But if you do feel lost in your trading and a bit stuck, then that will genuinely help you like it has with others. Now let's understand, what are we doing? Because I think this is very important to understand to make this work. Because we're diving into a whole lot of fancy concepts, but we need to see the bigger picture. What are we actually working towards? And the thing that we are working towards, or why it's called pips to payouts, is we might think, well, we're working towards payouts, right? Yes, as in we are working towards payouts. And that is what we are trying to achieve right here. No, as in it's a bit deeper than that. Now on social media around you, you might see people getting payouts, and also MMT members, you also see them getting payouts. For example, I show payouts in certain videos. It's almost like they have some sort of secret to it. But let me clear it up as well. There is no secret to it, so don't worry about that. But what a lot of traders do have is very good knowledge. So your knowledge might be very good. And that's usually also not the problem. Your knowledge is just good. You know the concepts, or you get to learn them through these videos right here. But still, even whilst knowing the concepts, you don't really get consistent results. So there's something, feels like something is missing. In that case, what often happens is that when you open the chart, there's noise on the chart. As in, yes, you can understand an order flow lag. Yes, you can understand fair value gaps and candle signs and what we can expect from the next candle. But that's still, if that's not implemented correctly, that's still going to lead to noise and not directly results. And again, feel free to let me know if this happens to you or it doesn't. You tend to go through a cycle of good trades, but then afterwards, or you might have 1 or 2 good trades, afterwards you feel quite lost again, where again, you have a new losing streak, but you're not too sure why. So it feels like, and again, question to you, it feels like you can't really explain the winner, so why it was a winner. And because you can't really explain the win, you can't repeat it. And that's the thing I'm trying to get at. Because when that's the case, usually that's a lack of control. There's a lack, more specifically, a lack of clarity. So what I was talking about, is it truly about payouts? Yes, but no, because indirectly, maybe it is truly about clarity. It's about stop feeling lost. It's about reclaiming that control with clarity. And once you have that clarity, you have that calm confidence where you know exactly what you're waiting for, when to press the button. There's no guessing anymore. And then that process leads to consistently getting payouts. So that's really the goal, clarity. So everything that we have done so far, for example, you'll notice, has been objective. And that's important because that then leads to clarity. And once we understand that, we can move on. And the first thing we also need to understand is ugly two-candle rejection. So for example, sometimes there will also be cases where there will be two-candle rejection, but it won't follow through. It won't continue higher. It won't really continue lower. It will just stay a little bit in the same spot right there. This is what we call ugly two-candle rejection. So where it's not taking 1 or 2 candles to continue, it actually takes 3, 4, sometimes 5. What we're looking at is a simple consolidation. For example, right here, when we have this bearish fair value gap, the first candle is a rejection, but also a long wick at the bottom right there. The second candle doesn't really do anything right there. It's what's an ugly two-candle rejection. When we see this is already a consolidation. Sooner or later, this will also lead to a bigger consolidation. So essentially, it's price action that we also want to avoid. The reason why that is because the momentum is against you. So the momentum is disturbed at that moment in time. Now, the way that exactly works with momentum, again, all things we're also going to dive into, because that in itself is a whole episode. Now, we see the same thing when, for example, we have a disrespect candle, the first candle right there, and we see something similar. So these are what is known as ugly two-candle rejection. Now, let's get into the rejection high/low. So when we create, for example, what we see right here, the same fair value gap, and we have this respect candle where we already have a rejection. In this case, it's the first candle that creates a rejection. When it's the first candle that creates a rejection, you mark out the low right there because that is the rejection low, and that's going to be important. Now, on the other side, when we have the first candle that doesn't create a rejection and the second candle does create the rejection right there, it's important to understand that the second candle is that respect candle. So the second candle is that rejection. So the rejection low is going to be the second candle right there. these rejection lows are important to understand. And the reason why these are important to understand, because they exactly tell us when a PD array is still being respected or disrespected. So remember what a trend is. What is a bullish trend again? A bullish trend is premium arrays being disrespected and discount arrays being respected. The rejection low or the rejection high based on two-candle rejection tells us whether a premium array or discount array is being respected or disrespected. The way it tells us that is, again, we start getting the full picture right here. So when we mark out PD arrays around us, we're going to get to a certain target. These order flow lags are going to tell us what that target might be. Now, what is important to understand is, again, like we mentioned in the episode 1 as well, is that not every order flow lag is going to be interesting. For example, if our target is going to be a premium array right there, we actually want to wait until this bearish fair value gap right there is disrespected so we can reach the higher time frame target. So right here, what we see is that we have a bearish order flow lag right there, and we have a bearish fair value gap. That bearish fair value gap initially right here is being respected. We already understand this is most likely going to be the next target. So this opportunity right here for the bearish two-candle rejection is actually not what we want to capitalize on. Do you remember what I talked about in episode 1? If not, I'll repeat it, because I said order flow lags don't have to hold to be effective. The same for a two-candle rejection doesn't have to hold for it to be effective. So essentially, you can take all our concepts and you can say, oh, but for value gaps, they don't hold. Perfect. They're still very effective. Oh, two-candle rejection doesn't always hold or doesn't always follow through with PD arrays. Perfect. It's still going to be very effective because then there's still going to be a certain pattern. Now, right here, as long as we are below the rejection high, like we see right here, we are still respecting this fair value gap right there. But in order for us to now take action, so for us to potentially trade towards this target, we need to disrespect this bearish fair value gap. How do we do that? The rejection high. If we start trading above the rejection high, and more specifically, we start running the rejection high right there, that means we are disrespecting the PD array that we have right there. Can you now also see why it's so important to only use PD arrays one singular time? They can only be traded to one singular time. That's it. Because if you take these random levels, you can't accurately know if a fair value gap is being respected or already disrespected, where now you can ignore it. And then when we have now a bullish fair value gap right there, we can then continue higher from it right there, from the bullish order flow lag towards the target. And we're going to dive into the chart as well to fully show you how that works. But right here, when we dissect this sentence, premium arrays, discount arrays, we understand those are the PD arrays. Disrespected and respected. Okay, what does it mean? Premium arrays, fair value gap, fair value area, swing high. Disrespected is running the rejection high of the two-candle rejection, like we saw in the example just now. Then the only thing that we do not know just yet is running. And that's going to be discussed, I'm sorry, in the next episode, but otherwise it's going to be very overwhelming. Where discount arrays being respected is then, like we mentioned, when you have the rejection high and we don't trade back above the rejection high, we are still respecting the PD array. So I used this same example in the last video as well, but now you can understand it a little bit more clearly. Because in that video, we worked our way down time frames. And the first thing we determined is that we saw bullish order flow lags right there, where we had determined, okay, well, that high is most likely going to be the target because of the fact that we have bullish order flow lags. So for example, the reason why those time frames are then so important is right here, we see on the daily time frame, we actually create this bearish order flow lag. But that bearish order flow lag right here, well, that disturbs it a little bit, right? Because that tells us we might still want to continue lower from that. So then do we continue higher? Do we continue lower? It's a bit confusing. Well, we follow the higher time frame. So we understand, okay, well, this right there, that was likely the next target. But this fair value gap, that's in our way. It's what we call, again, that resistance. And now we need to overtake, disrespect the resistance. And we know exactly how we want to see that, or what we want to see happen. Because this right here is the rejection high right there. Because this respect candle that we see from the daily fair value gap right there, that is the rejection high right there. So everything below what happens right here, it's not that interesting. That is where we are still respecting this bearish daily fair value gap. And I don't want to look at shorts. Again, the main target was that right there. So what are we waiting for? We are waiting until price starts running the rejection high. So that rejection high, when we start running it right there, now that becomes very interesting. Again, that's where I took the trade, and that's the whole logic behind it. The same way, when we retrace back into this fair value gap and the fair value areas, etc., to potentially continue higher, what do we see? We see that we have a 1 hour fair value gap going against us. Again, bearish order flow lag going against us. But overall, the higher time frame tells us we still want to be bullish. So if we now go into the 15-minute right here, where we are going to be a bit more advanced because we're going to use 2 candle rejection, 1 time frame below. 1 hour fair value gap, 15 minutes, 2 candle rejection. This right here is the 2 candle rejection high. Here we start running the 2 candle rejection high. That right there is where price is very interesting right there to then continue higher. And then what you'll notice is because you understand the order flow lags that we are not looking at, so that we are not looking to hold, we can then very accurately use 2 candle rejection in the right direction. So not just expecting premium arrays to hold right there whilst we are continuing higher. And the reason why this is so powerful is because I don't need to think right here about what is going to happen. I have clarity. So what we're trying to work towards is that you also become a clarity trader. You know exactly what you're waiting for. You feel like you're in control. And when that happens, you can consistently find those high probability trades. You can get to consistent payouts. So for example, right here on gold, I know we have this bearish fair value gap right now going against on the 4 hour. I am going to wait for 2 candle rejection sting into that right there. I'm going to determine the rejection high. Then if we run the rejection high, we are disrespecting the fair value gap. That clears up an area for me to trade to continue higher right there. I know every single step of the way of what I want to see. And that's not what I've done in just this time. I've done that with that high right there. I've done it with this trade right there. I've done it with that trade as well right there. Every single time I know exactly what I'm waiting for. It's clarity. It's calm confidence. Now, the only way you will truly understand this is if you also go into your own chart and you study this. Then this is the offer that I was talking about right here. In tradingmmt.com, we have a new module going on, which is the clarity module, which is going to be for the masterclass. Now, what I want you to imagine with that, because I already give you a lot of information right here for free on YouTube as well. But Trading MMT right there, and specifically as well, this new clarity module is where we dive deeper into this, where we really fast track you, where you also have personal guidance with a support team. The way you can imagine it, it is what you're seeing right here on YouTube times 10, where we take you from A to Z, give you everything very clear, more in depth than what you're seeing right here on YouTube, and how you can take that clarity to scale your capital to consistently get payouts. So if you're interested in that, I would highly advise, again, take a look at Trading MMT, see what we have to offer. And always feel free to ask if you're not sure. And then in the next episode, we're going to talk about what it means to run or sweep, for example, liquidity. All right, perfect. Thank you.